earn just $1 over the 2026 ACA cliff of about $60,240, and you can lose $4,000 to $12,000 in premium subsidies overnight. That is not a typo. A single dollar of income flips you from subsidized to full price. I read the fine print so you don't have to, and today I'm running the exact maths for 3 freelancer situations so you can find yours. The enhanced premium tax credits from the American Rescue Plan expired on January 3, 2026, per CMS guidance, restoring the original rule: no ACA subsidy at or above 400% of the federal poverty level. For a single adult in 2026, the cliff sits at roughly $60,240 of modified adjusted gross income. We're going to calculate exactly what happens on either side of that line for a freelancer whose income swings. Jordan is a 37-year-old freelance designer in a high-premium metro area with no employer coverage. They estimated $58,000 of MAGI for 2026, safely under the cliff, and qualified for advanced subsidies on a silver plan. But their actual income climbed to $61,000 during the year, past the $60,240 line. At 350 to 390% FPL, Jordan's expected contribution was about 9.96% of income, per the 2026 sliding scale, leaving a subsidy of roughly $4,000. Crossing to $61,000 wipes that out and can trigger repayment of the subsidies already received. A $3,000 income increase becomes a net loss of over $6,000. This is the cruel part of the 2026 rules. There is no gentle phase-out above 400% FPL. Jordan effectively worked harder, earned more, and ended the year thousands of dollars behind because of health costs alone. In this scenario, Jordan earns comfortably above the cliff the whole year, so no subsidy applies at any point. They simply buy the silver plan at full price with no premium tax credit. The question is how much of their income that unsubsidized premium eats. At $800 a month, that's $9,600 a year, per 2026 Metro Premium data, roughly 10 to 15% of Jordan's take-home income after business expenses. From 2021 to 2025, enhanced credits capped contributions at 8.5% of income even at higher earnings. So Jordan now pays several percentage points more than before. Scenario B has no dramatic tax bill, but it quietly drains $9,600 a year with zero help. If this is useful, subscribe. The next breakdown is already coming. Before I get to how this all compares, which is the most counterintuitive piece, here's the scenario that changes everything. Jordan learns their ACA MAGI can be legally lowered using the self-employed health insurance deduction, a solo 401k, and HSA contributions per IRS and covered USA guidance. Starting from $75,000 after expenses, Jordan deducts roughly $9,600 in health premiums, plus solo 401k, and HSA contributions, per IRS Form 7206 rules, pulling MAGI down by $10,000 to $15,000 to sit under the $60,240 cliff. That preserves an illustrative $4,000 to $7,000 in subsidies, and avoids the repayment bill entirely. The magic here is that Jordan didn't earn less. They simply structured deductions to land MAGI just below the cliff. Compared to doing nothing, this income smoothing can improve after-tax cash flow by $8,000 to $10,000 in some years, per the modeled framework. Scenario A, crossing the cliff by accident, costs a net $6,000 plus dollars from a small raise. Scenario B, over the line all year with no plan, quietly drains $9,600 in full premiums. Scenario C, targeting MAGI below $60,240 with deductions, preserves $4,000 to $7,000 in subsidies. Over a decade of volatile earnings, the gap between A and C can compound into tens of thousands of dollars. If your freelance income swings around $60,000 as a single adult, or around $81,160 for 2 people, you are living on this cliff whether you plan for it or not. The difference between Scenario A and Scenario C is almost entirely about modeling your MAGI before December, not after. Next, I'm covering exactly how the IRS Form 8962 reconciliation catches freelancers who underestimate income and the repayment caps that vanish above the cliff. If you want to catch that one before your next tax return, subscribe so you don't miss it.